Are you trying to buy a home and you have good credit and not a lot of debt? Well, if so, this video is for you. In this video, I'm going to do a quick breakdown on how conventional loans work, their requirements for 2026, and what you actually need to qualify. But first, let's start with a big misconception. Conventional loans are not just for those putting 20% down or those with flawless credit. They're available to a wide range of buyers, as long as you meet the basic lending guidelines. Now let's start with talking about down payment, because this is where most people get it wrong. You don't need 20% down. In fact, first-time home buyers can qualify with as little as 3% down. And in many cases, repeat buyers can get in with around 5% down payment. Now, when it comes to credit, conventional loans are a bit more strict when compared to FHA loans. Most lenders are going to look for a bare minimum of a 620 score. But once you really start to see those good interest rates is that 680 to 720. The stronger your credit profile, the better your loan terms will be. Now let's touch on the debt to income ratio. Lenders are still comparing your monthly income to your monthly obligations. But conventional loans tend to be a little tighter here compared to FHA loans. In general, you'll want to stay to a maximum of 45 to 50% on your debt to income ratio. Although there can be exceptions depending on the strength of your loan. One of the biggest advantages of conventional loans is how they handle mortgage insurance. There is no upfront mortgage insurance fee like FHA, so that 1.75% does not exist on a conventional loan. So if you are putting less than 20% down, you are still going to have monthly PMI, which is private mortgage insurance, added to your monthly payment. But here's the key difference. PMI is not permanent on a conventional loan. Once you build up 20% equity in your home, you can have it removed. Or it will eventually drop off once you hit 22% equity. That's a huge long-term benefit compared to FHA loans. It's also really important if you're trying to get the lowest amount of PMI added that you get your scores as high as possible. Because your private mortgage insurance rate, it's like an interest rate. It depends on how high your primary credit score ends up being. So every tier goes in 20-point increments, starting from 620, 640, 700, and so on. So 20 points is going to change your PMI factor, and it's going to reduce how much that monthly obligation is for private mortgage insurance. Another thing to be aware of are the conventional conforming loan limits. These loans have maximum amounts that vary depending on your locations, and they will change the type of conventional loan you end up getting. So it varies based off county, but the baseline conforming loan limits for 2026 start for a 1 unit, $832,750. For a 2 unit, we have $1,066,250. For a 3 unit, we have $1,289,250. And finally, for a 4 unit, goes to a whopping $1,602,750. Now, these are variable depending on your county. Once again, check and see if your county can go higher on these conforming loan limits. But if you are trying to get a conventional loan at higher than these limits are at, it's okay. They change what type of conventional loan you qualify for. There is 2 additional subtypes above your normal conventional loan. The next higher one, once we crack that conforming loan limit, is something known as a high balance. Now, a high balance is just going to have a little bit higher on the interest rate because the lender is taking a higher risk by lending you more money. The next tier is something known as a jumbo loan. And jumbo loans typically have a little bit higher on the interest rate, but also different qualifiers and different compensating factors that you're going to need to pass to get qualified. Now let's dive into property types. Conventional loans offer a lot more flexibility when it comes to the type of property you wish to buy. You can use them to buy your standard single family, any condominium, which FHA has a lot of challenges with that, townhomes, manufactured homes, you name it. So conventional loans are typically the most flexible type of loan you can get when it comes to the more unique property types. And also, best part is you can use a conventional loan for an investment property, which you cannot do for your FHA or your VA financing. The only difference is if you buy a property as an investment, you will typically need 15 to 20% down payment as your new minimum. Now, as far as getting pre-approved, the process is very simple. You'll need to provide the last 2 years of your W-2s if you're employed, or tax returns if you're self-employed. You'll also need to provide tax returns if you currently own any investment properties. If you're employed, we'll also need 30 days worth of your most recent pay stubs, the last 2 months of your bank statements, regardless of what type of employment or self-employment you have, a photo ID, and if we have any retirees here, we'll need things such as your Social Security award letter, pension award letter, anything that can verify guaranteed monthly income. Also, don't forget, you will need to allow that lender to do a full credit check to verify where your scores are going to come in at. And at the end of the day, conventional loans are a great option if you have decent credit and want to avoid long-term mortgage insurance or the upfront fee that dips right into your equity that FHA charges. But just like with any loan, the smartest move is to compare all of your options, whether that's FHA, conventional, or something else. And if you want to figure out what you qualify for, or if you need help using the conventional loan to buy a home, you can use the link below to book a call with me.